What's up, guys? It's Pac, and welcome to video 9, Trade Management, the Key to Long-Term Profitability. Now, in this video, we're going to be talking about a few things. Most importantly, where you're going to start with your stop loss every single time, how to trail that stop loss while you're inside of a trade to increase RR that way, and also how to pick the best take profits and how to extend those take profits while you're in a trade to make sure that you're increasing RR but keeping a higher win rate at the exact same time. So without further delay, let's hop in video 9. Okay, so here is our initial stop loss placement, which this is going to be the most important part of this video is your initial stop loss placement. Initial stop loss placement is very, very simple. It's just going to come down to I need to cover the entire zone that I'm trading from. Now, there's going to be zones within zones. If you remember back to video 2, zones within zones. Now, depending on my risk appetite and how aggressive I want to be, in this specific scenario that you can see on the screen, you would put your stop loss in one of two places. So the person that is rather risk adverse and would rather let a trade breathe and they're fine with going in a little bit of drawdown without getting stopped out and all that good stuff, they would simply cover the entirety of the high time frame zone of the high time frame swing point, which would be this entire gray zone would be the entire swing point. So they would cover the entirety of the swing. Typically I go 1 to 2 ticks below, usually just 1 tick, just in case it wants to come all the way down to the bottom. And you go for a minimum of 1 to 1, which I've talked about before. A minimum of 1 to 1. So this would be the person who is rather risk adverse, doesn't really need that super aggressive entry. They'd rather just let the trade breathe and work out because they believe this is the zone that we should get a trade from. Now, the second way that you can start with your initial stop loss placement is covering the zone within the zone. So in this example, this right here in the blue would be our SNDR inside of the zone. And once we get a tap and form a valid high or a valid low in this scenario, something like that, you would just cover the entirety of the SNDR, which would just be down here. Now again, you're going for a minimum of 1 to 1. And you can see this is going to be a little bit more aggressive. This can also lead to higher RRs if you were to leave this in the same spot that you were going to initially have with the larger stop placement. And this is completely up to you. I know people that do it this way with a larger stop, and I know people that do it this way. Both are correct, but we just have to determine on what our win rate wants to be. You're going to end up with a higher win rate if you cover the whole zone. Why? Because if price decided, hey, I'm going to run through this SNDR, or I'm going to bounce here and I'm going to run through it and use the origin and give that bounce, then you'll end up having higher higher win rate. You might end up with a lower RR though. So that's going to be your trade-off. If I put my stop here, I'm going to have a much higher win rate, but lower RR. If I put my stop loss on the SNDR, I'm going to have a lower win rate, but I'm going to have a much higher RR, as you can see by the risk-reward tool. So let's hop into the charts, and we'll just look at a couple scenarios and a couple trades that you could have taken. Right here is an example of what we just drew out with the path tool. Right here is a gray zone. We're on the 5-second chart. It doesn't really matter. It happens on all time frames, but this is the 5-second chart. The gray box is our swing point, is our previous swing point. And the blue box is, you guessed it, our SNDR. And you can see we tap off of it. We form that valid low when it closes there. We'll make this a different color, like purple. There. And you can see we get a nice reaction off of it. And this risk reward tool shows the person that covers the entirety of the zone and goes for a 1 to 1. You can see that this trade does hit. This trade does hit. Now, that gives you your 1 to 1. And another option would be the person that we talked about, person 2, who just covers the zone that you're trading from, which would be the SNDR, the internal zone. You can see that this person, if they were still going for that initial 15 points, they would get stopped out. Now, this does give you 7 1/4, 8 points there as an entry. So to me, that's plenty. To me, a lot of the times, I just go for a 1-to-1 off of these zones because I'm not greedy. But if you are somebody that likes to target highs and liquidity points, just know that this is your more aggressive entry. If you start down here at the bottom of the zone, you're going to win a lot more trades. So that's just a quick example of the two trades that I was just talking about on the path tool. Right here is another example. This is just going to be to the short side of the exact same thing. We have our previous swing here in the gray. We have our SNDR here in the blue. And you can see we tap into it, form a valid high, and then we start trading down. Now, again, the person that covers the entire zone, they're rewarded with the winning trade with the entire 1-to-1. The person that just covers the SNDR, they're rewarded with a new low being made, which is, again, a 1-to-1, a little bit more. This provides 5.5 points. So, again, this is completely up to you. I always recommend starting my stop here with a 1-to-1 and then manage from there. So, let's hop in. How do we manage a trade while we're inside? All right, so this is how we're going to manage our trade after we've already entered. So in this scenario, we're going to be entering the trade here at the valid low that occurs within the SNDR. I'm going to change this to a purple zone. We're going to be taking the trade from here, from this purple zone. We're going to start with our stop loss at the bottom of the swing point to be safe. And we're always going to trail one zone behind. We're always going to trail one zone behind. So what does that mean? So as price taps us in, I'll even put a little tool here so we see our initial. Say we're entering here. This is going to be our initial trade. Something like this. Something like that's going to be our initial trade. When price comes above and closes here, we're going to trail one zone behind. So when it closes there, what am I going to do? I'm going to move my stop loss to right below the SNDR. Immediately below the SNDR in this scenario. Which, as you can see in this scenario, this changes our trade from a 1.8 all the way to a 4.4 just by, or 4.3 just by moving that up. Now, once we break this high up here, what does that make this low? That causes that low to be the low and protected in a new swing point. So what am I going to do? I'm going to take my stop loss and I'm going to trail it up right to that low. Why? Because that's our new protected point. And then so on and so forth until we get to our target. So once this breaks back up this way, where am I going to move it? I'm going to move it below the SNDR, which let's just say the price comes down here. That means I'm going to move it to our new point, which would be where? Would be right there. That's basically break even now. And then as price trades up above this one, I'm going to move it up above into our new protected low. So we're just always trailing a zone behind, because what can happen is, the reason we want to start covering the whole zone, whichever 5 second, 1 minute, whatever it may be, the reason because we do this is sometimes, let me get rid of this so I can do this. Sometimes price will decide it wants to do a double tap down here and just wick that one out, or sometimes just wick the protected low out but not close and bounce off this SNDR again. If I've already moved here or moved here, well, now I get stopped out and I don't hit my TP. So we always trail the one zone behind. Now, let's hop in the charts. I'm going to show you a couple examples. Okay, so here's an example of a trade that we would take long and how to manage the trade. So, why are we getting into the trade first of all? Well, we shifted structure to the upside. We traded back into the SNDR and we formed a valid low right here. So when it taps back in, we're going to cover the entirety of our zone and then we're going to start trailing our stop up. So how are we going to do this? Well, like I said in the initial scenario that we just built out, once it closes above the high that sent it down, once we get that close on this candle right here, on this bullish candle close, right, oh, snap, right here, we're going to move the stop up to below the SNDR, up to below the SNDR. So we're going to move it here. Now, once we put in a new valid low, which there's no valid low that occurs here, okay? There's a valid low that occurs right here. So when that trades up above this one, we would move the stop up again into below the protected low that occurred there, okay? So all in all, by the time this trade hits your TP, you have resulted in a 4RR. Now, even if price decided, hey, I'm going to lose here, I'm going to not hit that TP, I'm going to trade all the way back down, I've reduced my risk in this scenario from 10 points all the way to 2.5 points. I don't know about you, but losing 2.5 points is not going to be that big of a deal in the long run. Let's look at another example. All right, so here's another example of how we're going to trail our stop loss. So again, we're inside of our zone that we're looking to trade from. We're inside the subzone, which would be the origin here, that we're looking to trade from. It forms that valid low. So once it occurs, we take the long and we cover the low of the zone. Now, in this scenario, you can see that the high that brought that low is all the way up here, is this one right here. So in this scenario, we would not be able to move our stop at all if this is what we were targeting. Now, if we were targeting something way up here, then when price closes here, then we can only move our stop up just a little bit, just up to this low there, because there's no structure within here that we can trail on. So this is a scenario where it just wouldn't move that much. You just would not move the stop that much. You wouldn't want to trail every candle because you run the risk of it possibly stopping you out and going. So you always want to trail the substructure that forms. You always want to trail those little valid highs and lows that form on whatever time frame that you're doing. That way, you're always in a protected structure on some sort of time frame, because all these swings, even this little swing here, that's like a protected structure on a lower time frame, So if we go up a time frame or you go down a time frame, you would see that's where my protected structure is at. So we're always following those little valid highs and lows. Let's look for another one. Let's see. One here, for example. Okay, this was the zone that we were looking to trade from. And let's say that this was the origin here. And so once it forms that valid high, which occurs there, let's say you were taking a trade, you were doing a buy stop. So you buy stopped this and you took this trade, just for example's sake. And you started with the cover of your whole zone, and you go a minimum of 1 to 1. Well, once we close this low, where can I move my stop? Well, I move my stop right up to here, right? That's where I'd move my stop to. And then when this low gets closed, where do I move my stop now? I would move my stop to above this high, because that's our new protected structure. And then once this low gets closed below, where am I moving now? I'm moving it another zone down. I'm moving it another zone down. And then that's when we'll end up hitting our TP. So by the time we hit TP, we're actually 5 points in profit. So no matter what on this trade, we end up profitable. Now, see how quick we're able to move that? This went from a 1 to 1 all the way down to almost a 5 RR. Almost a 5 RR, and we didn't even have to aim for the lows. The lows didn't even have to get taken out. So now we transition into, where should my actual take profit be? where should the best take profit be? The take profit I'm gonna suggest to you, and we're gonna hop over to a little scenario here. So I'm gonna suggest to you that the best place for your take profit is not gonna be in this scenario. If we're looking for it to go long and continue, we're not gonna try to take our take profit here at the high. We're gonna try to take our take profit at the candle that puts in the high. So that might look like something maybe like right there, for example. Why? Why is that something that I would want to do? The reason being is, first off, as long as it's a one-to-one, that's where you're starting. You're always starting at a one-to-one. So let's say this example, let's make it a one-to-one so that it makes sense. Let's say this was one-to-one. We're covering our entire zone. Awesome. The reason I wouldn't want to take at the high is because that requires me to be 100% correct that we're going to continue bullish. 100% correct. If I take it at the origin or the candle that put in this high, the low of it, this requires me not to be 100% correct. And this allows price to do what price likes to do. If you recall in video 4, price expectations, what is the most common price expectation model? Is it not this one? The one that approaches the high, pulls back, and then goes? So this allows me to take advantage of price model 1, it pull back, form another valid low somewhere in here, and take an additional trade there. So now instead of taking one trade that might produce 27 points, I can take a trade that produces 21 and then potentially another trade that produced 10, and so now I got 32 points out of a 27-point move. And that's how you can maximize it. And let me show you some examples of where, what if price decided, oh, well, I'm just going to tap that, and then I'm just going to come all the way back down to the origin and fail. Again, I don't have to be 100% correct. I just have to be right in the direction of the move. So let's look at a few examples of where, it does something like this and gives you 2 entries, but let's also look at some examples where it just taps that and then disappears and goes all the way back to your stop loss or your break even. So right here is the previous trade we had just talked about and how to trail it and everything like that. As you can see, price trades right into the candle that has the lowest point, and that's what we're looking at. We're not really worried about bullish or bearish candles or valid high or low. Now you can use this one here. It'll do the same thing regardless. But look how price taps that and pulls away. Now, price very well could have tapped that and flipped all the way back up. And you would have been like, oh no, it hit my break even. What the heck? I was 3 points away, and you'd be all sad. This right here gives you another opportunity to trade off of this valid high that never gave us an entry. So now instead of taking one trade that produced 33 points, you're taking one trade that produced 26 points. And now you're taking another trade that produces, once this one goes and takes the low, that produces 17 points. And so now that's a 42-point trade instead of a 33-point trade. You're maximizing your RR. You're maximizing your wins. Now, here's a prime example right next to it, a trade right next to it that does the same thing, but it pulls all the way back. So let's say I wanted to take this trade again. And I took this one. Maybe I was late on the other two, and I'm covering here. Look what happens here. It taps the candle that has that, is the last little candle, last little down point. You could even use this one. It doesn't matter, okay? You're going to end up with a 1-to-1 no matter what, but this one gives you at least a 1-to-1. Let's say I'm targeting here. If I'm targeting here, well, my stop loss definitely gets hit, right? It never comes down, and then it hits my stop, and then lo and behold, look what happens. It comes all the way back down and takes it. It took me out, and then it hits my TP. And I know a lot of you guys are like, man, I get stopped out and then it goes my direction. It's like, because you're not picking the best TPs. Let's see, for example, if I took that one there, okay? And let's say I took, I don't know, this trade here, I guess. I don't really see one in here. And then let's say I took this trade in here, okay? Say I took that trade in here. Cool. And again, where do I target? I can just target this candle here. I can target this candle here. When it does it again, when it comes back up and forms another one, let's say I somehow got into a trade here. Maybe this was your trade, just for example's sake. Well, now I can target this one. And these are all I can do one-to-ones here, but just think about it. This initial trade idea to take this low is 19 points. This right here produced a 12-pointer, a 14-pointer, and a 12-pointer before it ever took that low. So now I've just essentially turned a 19-point trade. I've maximized my RR because I didn't have to keep my stop loss all the way up here. I've maximized my RR, and I've allowed myself to not have to be 100% correct 100% of the time. And that's the key. The reason you don't want to take lows and highs, like the very extremes, is because you don't want to make yourself be 100% correct 100% of the time to win a trade. You want to be able to say, hey, I know the direction and I know that it typically touches this point. I don't need it to take the high or low. I don't need it to take the high or low. For example, there's another trade right here. Let's say I was going bearish on this candle here off of this there. Okay, let's say I was covering this high. Let's say I was going a one-to-one. Something here. Because we'd be able to move this here. Let's say that I did aim for this and I lost. Okay, that's okay, because this one didn't deliver. But if I'm aiming for the right candle, if I know where my right candle is, and I'm supposed to be aiming for here, is that a trade I'm going to take? Probably not. Why would I not take it? Because the RR is terrible. It's a 0.4. So if I have to have such a big RR, and this is where it's definitely hitting, remember, that's the idea, is that's where it's definitely hitting, then I'm just going to wait for another setup to occur. And when the next setup occurs, I mean, bang, you get that run through. And this is an example of where it just runs straight through, right? There's just pure run through. And that's okay. But this doesn't happen as often as that price model 1 occurs. If you watched video 4, what did I talk about? Price model 1 occurs 70% of the time. And you can see that occur here and here and there and there and there and there and there. Right? The one time it just runs straight through it, you've already had 1, 2, 3, 4, 5, 6, 7, 8 times where it tapped that area and then rejected. So stop making yourself be 100% correct, okay? That's the theme of your take profits. You don't need to be 100% correct. You just need to be correct enough to make money. So I hope guys that video helps you with where to put your stop loss to start, how to trail your stop loss, and how to pick appropriate targets. See you